Hello and welcome to the Market Perspectives for the first quarter of 2017. My name is Matthew Adams, Chief Investment Officer, Mission Wealth. Key themes, at the end of the quarter, produced some very strong equity returns in the United States in particular. The S&P rallied nearly 4% for the quarter, with smaller companies, as measured by the Russell 2000, leaping nearly 9% after the election. Energy stocks, financial stocks, and other cyclicals fared very well. There's speculation of regulatory reform, possible corporate and personal tax cuts, and all of the factors that we just simply won't know until well into 2017 as we see what unfolds with Congress and the Trump administration. Interest rates did move up sharply towards the end of the fourth quarter. The Barclays Aggregate Bond Index lost nearly 3%. Much of that coming in the final weeks of 2016. Again, some of the loosely proposed changes to trade policy were cited as a potential source of inflation. Some strong economic data as well came on in, and we had good employment figures. So really, much of the spike in interest rates in the final portion of 2016 was really just a renormalization of interest rates, and we'll get into that further in subsequent slides. Finally, certainly political uncertainty in the first 100 days of the Trump administration is on most of our clients' minds. We'll talk a little bit about the shift towards some other populist political parties around the globe, and certainly trade is in focus and what the implications there would be for upcoming changes. Turning to the economy, the forecasts have increased to approximately 2.3% gross domestic product growth for 2017 as well as the first half of 2018. This is an increase. Previous forecasts had it at approximately 2%. And again, the main reason there is expectation of fiscal stimulus and tax cuts both at the corporate level and personal level. We've seen inflation measures tick up. They're largely over 2% at this point in time. That's in the Federal Reserve's comfort zone. Some of the impact of oil prices and the drop in prices that was seen in 2014 and 15, that begins to fade on a year-over-year basis. We've seen very strong employment figures. The unemployment rate is well below 5% and generally forecast to reach about 4.5% within the next year or so. That's a level at which we've historically seen wage pressures begin to really tick upward. So that would be definitely a source of inflation. Looking at key forecasts, the equity markets are at or near record highs, certainly in the United States. We still have valuations as above normal, but not stretched at this point. Bond yields, we noticed, were more volatile in 2016, but ironically, they finished 2016 about where they started the year. There was just a bit of a roller coaster ride in terms of interest rates, dipping very, very low mid-year and then rebounding sharply after the election. We're looking for the U.S. dollar to remain strong against developed currencies, against the yen, the euro, and the pound. Higher interest rates as well as higher economic growth rates should be the predominant factors keeping the dollar strong. Energy had a great rebound in 2016, roughly doubled in price when thinking about crude oil. We're looking for a period of time where maybe we see some price consolidation. Supply and demand are still working themselves out. But we've definitely had a rebound from the lows in early 2016. Metals, we look for those to move upward, but just gradually, and certainly there's a tie-in to the inflationary expectations there, particularly with gold. Changes to our forecasts, we're still preferring a globally diversified portfolio. We believe that a portfolio tilted a bit more towards equities makes sense given the current environment. In terms of items that we're a little bit more conservative on, we're being more defensive in terms of our posturing with sovereign bonds, including U.S. government bonds, municipal bonds, and just preferring a slightly lower duration and shorter maturities. This is intended to mitigate the impacts of a rising interest rate environment. And then finally, one of the areas that we believe we want to hedge out is currency risk. So where feasible and where it makes sense, we are hedging out the currency risk associated with international stock investing and choosing a currency hedged solution. This is an extension of a theme that we've been pursuing for several years now. Interest rates. We do expect interest rates to gradually move upward. Here's a forecast showing the glide path from the current level of approximately 2.4% up above 3% over the coming years. We believe that the Federal Reserve will also have good reason to renormalize their interest rate policy and move rates higher. And we also are seeing a nice rotation out of bonds and into stocks. We believe that this is a pattern that can continue for some time. There is certainly the belief that the repatriation of foreign earnings will bring hundreds of billions of dollars back into the hands of corporations here in the United States, and that much of that influx of cash could be used to repurchase shares on the open market. So that's certainly a rotation that we saw sharply take off right before the election, and it's continued its extension. We do believe corporate bonds can perform better than treasuries in this environment. Typically, you see credit spreads compress. That would move corporate bond values higher, and so a tilt towards shorter duration and then a tilt towards credit and away from sovereign debt and treasuries, we believe is a good tactical move. Another model that looks at interest rates, the Taylor rule. This is a widely adopted model in place for some time. This is a chart that details the interest rate that would be implied as appropriate by the Taylor model over the last, call it 20, 30 years. And then the blue line indicates the actual Fed funds target rate and where that was set in relation to the Taylor rule. You can see that in the 08-09 recession, the Taylor rule would have indicated an interest rate of approximately -6% to -8% as being appropriate. That was the depth and extent of that recession. Obviously, the Federal Reserve is limited in its tools to move below zero interest rate policy, and there we have been for the better part of a decade. You can see now that the Taylor rule would indicate that those short-term interest rates should be set higher by our central bank, and the Federal Reserve has made comments and indicated quite clearly that they do intend to raise that short-term Fed funds rate multiple times here in 2017. Turning our attention to politics, we've got a slide here talking about some areas of global transition that we see happening, a shift towards populist politics, a shift towards inflation, a move away from monetary policy, and a move towards fiscal policy. This would be governments stimulating the economy via spending, tax cuts, and then a move perhaps away from regulation and one towards deregulation. These are obviously four main themes that we still need to see how they pan out, but the geopolitical backdrop has certainly become more volatile lately. We see some positive and negative economic implications between these types of shifts, but what we do see are shifts that are largely inflationary in nature, whether that be protectionism on the trade front, fiscal stimulus, and certainly deregulation. All could lead to some more inflation pass-through. The calendar for 2017 is certainly busy. We've gotten through the first event here with the presidential inauguration here on January 20th, but you can see that the calendar is quite packed going forward. We do believe these events can lead to some near-term volatility. We remember, of course, Brexit in the summer of 2016, certainly an unexpected event, did roil the financial markets for a period of several days, but that wound up being a very short-lived event, and the markets corrected themselves. And we do want to remind our investors that we believe in the benefits of a long-term asset allocation and being patient and certainly being able to tune out some of this short-term volatility and noise that inevitably happens every year. Trade policy, that's been in the news quite a bit. There's been great uncertainty as to whether or not the Trump administration will attempt to put through more trade tariffs, most notably on Mexico and China. This is a heat map indicating the amount that the U.S. exports to various countries and the amount that in blue it imports from various countries. And the point being here is that we have a very interdependent global economy. The conventional economic wisdom would suggest that any tariffs that are put in place are typically very bad for consumers. They lead to fewer choices, higher levels of inflation, and ultimately are somewhat self-defeating, as tariffs placed on other countries typically result in those countries placing tariffs on us. So insofar as trade policy can remain as open as possible, we believe that to be a positive. Insofar as trade policy becomes more closed off, we expect the primary casualty to be the consumer, where we see a little bit more inflation passed on. So with that, I would just say that 2016 was a very good year in terms of absolute returns and risk-adjusted returns. Many of our non-core asset classes, those used to diversify our portfolio, such as emerging market stocks, emerging markets debt, floating rate bonds, high yield, master limited partnerships, small cap stocks, these all produced very strong double-digit returns for the year and did a great job of diversifying our portfolio. As always, we take the opportunity to tax loss harvest where opportunities arise. So with the sharp rise in interest rates after the U.S. election, we took the opportunity to swap our core fixed income investments, book those losses, with the idea being that those losses can be used in current tax years or in the future to maximize the after-tax return for our investors, make sure that our clients keep as much as possible in their pockets and pay as little in tax as possible. Looking ahead, the investment committee is very focused on a rising interest rate environment, certainly the renormalization of central bank policy, and the ongoing shift in our global political situation. So, we're looking for alternative investment themes and ideas to certainly take advantage of this environment. And should you have any questions, please feel free to contact your client advisor to get more information. As always, I thank you for your attention to this Market Perspectives, and we'll look forward to the next one. Thank you.